Hello and welcome back to the YouTube channel. In today's video, we're going to be breaking down our cash flow in 2023, sharing all of the income in our property portfolio and all of the expenses. I'm also going to be talking you through some of our future plans. So what will happen when our fixed rate interest rolls onto variable rates, and what's going to happen as we rejig the portfolio and potentially buy a motel in the near future. So if you haven't seen the original video already, click this video somewhere over here to look at the original numbers in our property portfolio from around 18 months ago. So let's just dive straight into the latest numbers. So the first property on our list is property number 1. And that brings in $1,715 or $89,180 per year. Now this property is around 2 to 3 kilometers north of Brisbane in a suburb called Kelvin Grove. It's a massive home, roughly 6 bedroom, 3.5 bath on a 300 square meter block. Now this home is in a very good position. Walking distance to the QUT precinct, walking distance to the city, and not far from the Victoria Park Golf Complex. When Emily and I first bought the home and we were first married, this was our very first property. So we moved in and lived downstairs. And what we did was house hack. So we rented out the rooms upstairs, saved electricity, saved on water, saved on rates and bills and interest by renting out some of the rooms and house hacking. While Emily and I lived there, this was our very first renovation. So we pulled down some walls, we added a kitchen, we upgraded the bathrooms, and then we eventually moved out. And recently we've done an additional toilet and upgraded the laundry. Now, over the long term, we still need to do some renovations on this property. It needs a full exterior repaint. It's quite an ugly color at this point in time. And so we'll be budgeting some money for this house to do that full repaint in the near future. We have no plans to sell this home. It's in a very good location and we're very bullish on Brisbane over the next 7 to 10 years. With the Olympic Games on the horizon, this property is really going to benefit. Now, off the back of our first property, we made our second property purchase, which was the Baby Queenslander. Now, this was the first renovation series that we documented here on the YouTube channel. The property currently rents for $480 per week, which is $24,960 per year. Now, the property when we bought it was in significant disrepair. It hadn't been renovated for a very long time. So Emily and I pulled up the old vinyl flooring, we sanded the floors, we repainted the house, we updated the kitchen, updated the bathroom cosmetically, and then rented the property back out. When we first bought the property, the rental appraisal was around that $350 to $370 per week. And after completing the renovations for about $35,000, we were able to increase the rent to $450 per week. Now, currently it's at $480 per week, but market rent in today's market would be around $550 per week. So there is room if we wanted to increase that rent over time. Now this leads me into our latest investment purchase, which was the unit block in Coffs Harbour. Now this was quite an exciting purchase. We bid at the property online. We didn't actually visit the home and we bought it sight unseen. So it's a house at the front and 3 units at the back. And it currently rents for $1,950 per week or $101,400 per year. Now we're really happy with this purchase. It's got some great long-term development potential because it's got dual frontage. The units can be renovated, and that's exactly what we're going to do. So over the next few months, Emily and I are going to head down to Coffs for a week or two, renovate the units with some help, do some painting, do some flooring, update the kitchens and bathrooms, and add value to those properties. So we should see the rent slightly increase because of those renovations, and we have plans again to hold this property for the long term. So this leaves us with a current total income generated from our property portfolio of $215,540, which is $4,145 per week. Now make sure you stick around to the end of this video because I'm going to be running you through different scenarios, in particular what happens when our fixed rates roll off onto variable interest rates and our plans to buy a future motel and maybe sell one of our properties. So let's kick on with operating expenses. So we're excluding depreciation and tax effect accounting for these numbers, and the first item on the list is the vacancy contingency. Now this is not actually an expense in our portfolio, but it's more of a buffer, and I like to include this number in our cash flows. So this would be $159 per week or $8,290 per year. Now this is a 2-week vacancy period and it covers handovers between tenants, or if we want to get into the property and renovate, gives us a couple of weeks of headroom. So it's good to have this in your buffers when you're running your numbers. Now, the number most people will be interested in is this interest bill number. Currently, we're paying $2,108 per week, which works out to be $109,608 per year. So that's a bit of a mouthful, but over $100,000 in interest at the moment. So roughly 50% of our debt is fixed at a lower interest rate in the high 2% mark, and 50% of our debt is sitting around that 6 to 6.5% variable interest rate. So I'll show you very soon what it will look like in the higher interest rate scenarios once we roll off that fixed period in the new year. One more thing before I move on, when it comes to managing your interest bills, it's the largest expense in your property portfolio. So make sure you're working with your lending manager at the bank or working with a broker to break down these numbers and get the sharpest rate possible. Sometimes rate is not the most important thing because you're trying to build your asset base first. So make sure when you're dealing with your broker or the bank, you get the sharper interest rates, but also make sure you're maximizing your ability to build the property portfolio. The next item on our list is management fees. So it's important to hire a professional property manager to look after the home for you. They should also point out things that need work, repairs and maintenance, or things that you can add value to the property. So if you can add amenity or cosmetically update the property to increase the rent and increase the value. A good property manager should be proactive on these things and regularly inspecting the home. So we currently pay that $9,730 per year, which is that $187 per week for our property managers. So we personally manage our first home and our remaining properties are managed by property managers. So make sure you find a good property manager, and the going rate for a property manager here in Brisbane is around that 7 to 8% mark on rental income. So the next item on the list is council rates, and they work out to be $340 per week or $17,692 per year. Now, council rates have significantly increased over the last few years, in particular because each of the state governments have gone around and looked at the land values of each of our properties. And most of the properties have increased between 25 to 50% in terms of land value. And what that means is the council can charge you more money for your rates because it's based on the taxable land value. This also hits you with land tax, so you've got to be aware of that. Now, to answer a lot of people's questions is why don't we have land tax in this list, is because Emily and I have structured our property portfolio in a way that we currently don't pay any land tax. We're below all land tax thresholds in both personal and company trust structure names. So take that into account. There are some ways you can do that, and I have videos on land tax and personal name structures, so go and check those out if you're interested in that information. The next item on the list is insurance, and we currently pay $87 per week or $4,542 per year. Now, the big question here is, how is that bill so low, Luke? And there's a couple of answers to that. So one, Emily and I maximize our excess. We always use the highest excess with our insurers to minimize our premiums because we only ever plan on using the insurance in case of a disaster. Otherwise, we've got that contingency. We've also got money sitting in our offset account for each of our properties as a cash flow buffer in case emergencies come up. Now, for some people, having both building and landlord insurance gives them peace of mind. So you need to decide what's right for you. The last item on the list is maintenance. Now, this is quite a contentious one with most people here on YouTube, and this is $173 per week or $9,000 per year. Now, the way I like to look at it is this is just general maintenance. So when taps break or you need to send out a plumber or a sparky, a switchboard blows, it's going to set you back $800, or a hot water tank blows, that's $2,000. So for Emily and I, around that $9,000 per year for our current property portfolio is suitable, but you need to work out what's right for you. Now, we also have a renovation budget which sits outside of the maintenance budget, and it's not included in these cash flows because, in my opinion, we're creating value, we're adding equity, and we're increasing the rents when we spend money on those renovations. So Emily and I like to focus on cosmetic renovations, and we help clients with cosmetic renovations here in Southeast Queensland. So if you're buying in Brisbane or in Logan City Council, Redlands, Moreton Bay, parts of Ipswich, or parts of Northern Gold Coast, we can also help our clients with cosmetic renos. So we do projects with clients between $5K to $100K and charge a straight project management fee of 20%. So Emily and I have a lot of experience in this cosmetic renovation space, and that's why we have it separate to our maintenance budget. So this leaves us with a total expense of $158,862, which is $3,055 per week. Now, this is the big drum roll. So the total net income is currently $1,090 per week or $56,678. Now, there's a couple of things you haven't factored in here. So we haven't factored in depreciation benefits, which would actually help our cash flow, or tax effect, which would give us some negative gearing benefits. The other thing we haven't factored in here is cash sitting in our offset account. So cash sitting in our offset would actually reduce this interest bill, but I've given you the full interest bill to see it as if there was no cash in our offset account as well. So we're currently grossing that $57K per year in our property portfolio. But things are about to change. So I want to give you two more scenarios of how our property portfolio is going to develop and how that's going to change the numbers. The first big one is moving from some fixed rates to variable rates. So our fixed rates for half of our debt is sitting around that 2.79%. And it's going to be going up to around that 6 to 6.5% range in January. So let's have a look at the numbers now and see what the changes are. So the big reveal, if we have rates sitting at around that 6 to 6.5% mark, that would leave us with an interest bill of $162,319, which is $3,122 per week. That would take our net income to around $76 per week, or $3,967 per year. So as you can see, a change in interest rates has the biggest impact on the cash flows in the property portfolio. Now, this is realistically where our property portfolio is going to sit from January 2024. So it's very important to run your numbers and stress test your cash flows. As I mentioned earlier, the numbers here don't take into account money in our offset account, but we are planning on using most of our offset account money over the next few months or years on our major renovations on the Triple Gable Queenslander. The exciting update for you at this point in time is the home's currently lifted up in the air. They've poured the slab and the chippies have started framing off downstairs. So we're really excited to be bringing that renovation series to you guys in the new year for our Triple Gable Queenslander raise and build. Now, it's important to understand that Emily and I are more in the consolidation phase of our property portfolio than we are in the accumulation phase. As we were building out our property portfolio, we focused on growth first and then transitioned to more cash flow assets. So the property on the north side of Brisbane, that was our first home, only a few kilometers from the CBD with that value add potential. We renovated the home, we did some house hacking, and we refinanced and moved out and bought our second property. And that was the Baby Queenslander, which you can see on YouTube. Again, renovating the property, adding value, and renting out the property. That enabled us to buy our own home, which is not on the list today because it's not part of our investment portfolio. It's part of our broader portfolio, and it doesn't bring in any cash flow. It's $0 per week. So after buying those 3 blue chip assets with value add potential, we were then able to make the purchase in Coffs Harbour, which was particularly a cash flow play. So that property, as you've seen, generates around that $100,000 per year. And as we look to pay down the debt over time and manage our portfolio, also add value to Coffs Harbour, the rents will slowly increase over time, the debt will slowly decrease, and we'll have a stronger and stronger cash flow each year. Now, the last variation of the numbers I want to show you is our plan to buy a motel. We're planning on buying a motel in the next few years, so keep an eye out for that when it eventually happens. So in order to do that, we need to make some changes in our property portfolio. Now, property number 2, which is the Baby Queenslander, we're planning on selling in mid-2024. So we're going to ask the tenants to vacate, we're going to stage the home ready for sale, and put it on the market. Now, there is still some great growth here in Brisbane, but we've been able to use that property and refinance multiple times to purchase other assets. Now what Emily and I want to do is sell that asset, take the remaining cash, which should be around that $200,000 to $250,000 on the high end, or $150,000 in the worst case scenario. And we'll be able to use that cash in our raise and build project here on the south side of Brisbane. Once we complete the raise and build on the south side of Brisbane, our home is going to hopefully be worth between $1.8 and $2 million, and we'll have spent between $400,000 to $600,000 on the major renovations. That should give us significant equity as we're looking to hopefully double our spend on the renovations to create more value in the home. So say we spend $400,000, we're looking for an $800,000 uplift in the Triple Gable Queenslander, so we can use that equity to refinance, re-leverage ourselves, and have funds to buy a motel. So this is the impact that it would have on our property portfolio. So if we sold property number 2, we'd lose its cash flows, and that would leave us with gross income of $190,000. Now, each of the expense categories would also decrease. So vacancy would drop, interest bills would drop, management, council rates, insurance, and maintenance would all fall, leaving us with total expenses of $165,016. So our net income, if we were to sell the Baby Queenslander, take around $150,000 to $250,000 worth of capital and reinvest it into our own home, with the view to reinvest that in a motel in the future, that would leave us with cash flow of that $25K and put us in a very comfortable position going forward. Now, it's really important to note that we're not using this income to live off at this point in time. That is the plan when we retire, but I currently run a buyer's agency here in Southeast Queensland called Purpose Property, and we help people, both investors and owner-occupiers, buy in the Southeast Queensland market. So if you want to head over to purposeproperty.com.au and book in a free strategy session with myself, we'll sit down, have a chat about your situation, talk about your goals, talk you through our process and how we can help you buy a property here in the Greater Brisbane market. So this has been a breakdown of our cash flows as of today, where we'll be in the new year, and our plans for the future to potentially sell one of our properties and look to buy and invest in a motel in the future. It's important to find the balance as you build out a property portfolio. As I've said all along, you need to focus on growth first and cash flow second, because a small percentage of growth on a large asset base will make a significant difference to your life as compared to a small percentage of growth on $25,000 to $50,000 per year. So you need to take this into account, and then over time look to consolidate your debt, maybe sell off some properties, and then look to retire and live off the passive income. What leads to people's success in building a property portfolio doesn't always lead to their success in living off their property portfolio. So it's important to reevaluate your strategy as you go along, work out what you're passionate about. Are you interested in reno projects? Do you have an interest in developments? Or do you just want to buy a set and forget property? So find out what you're interested in, look at the data, both quantitative and qualitative, to help you make the right investment decision, and then take each step as it comes. Buy that first property, look to add value if you're using our strategy, refinance and go again, and reevaluate your property portfolio as you go along. That's exactly what Emily and I have done. After we bought our first home, added value, we bought our second. Then we looked to buy our own home because that's the stage of life we were in. Now we've bought a unit block most recently to boost the cash flow in our property portfolio. So you need to reevaluate and find the balance as you go along. I'd love to hear your thoughts in the comments down below. Let me know if you think these cash flows are realistic and where your property portfolio sits at this point in time. Thanks for sticking around. I'll see you in the next one. Peace.